Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Hello and welcome to the Southeast Retirement Planners Podcast. I am Ryan Edwards, and I'm here with Les Stewart today.
Hello.
We're looking forward to sharing some information on what's going to be a two-part mini-series, if you will.
Very many.
Of behavioral finance. So today we'll take off our financial advisor hats or combine them with that of maybe a psychologist, you could say, because behavioral, what we're going to be talking about today is why do investors make the decisions that they make, okay? Mm-hmm. And along behavioral finance is basically, per definition, it's the intersection of behavioral psychology and finance that explains why people make irrational financial decisions, and it informs every financial decision we make. So we talk about this often, Les, that we change hats.
It's a huge factor on a investor market level scale, but even when you get down to the individual investor, it's even more important. And knowing how to kind of diagnose what people are going through and what stages they're in is really important. So I think that people are going to get a lot out of this.
Yeah, definitely. Well, let's kind of jump in and before we even get to the different scenarios or different biases, if you will, is it helps us to study this as well, because having an understanding of this as an advisor helps us help investors not make emotion-driven decisions. We don't want we always say we don't like knee-jerk reactions, right, because they can lead to unnecessary losses.
Right. Well, we're all humans too, so nobody is immune to having the emotions or feelings or thought processes. It's just how you deal with them, right? So,
right. And over time, that's those changes are naturally impact decision making over time. Like you said, human nature is one, and hardwiring and means of processing information. People have their own way of processing information, mm-hmm, and then they have coping mechanisms too, as well as per their emotions. So we and this has taken place over decades of just one of the things, the technological evolution has played into this, whereas the advancements have taken place over decades that have shaped the way humans interact with one another. You're talking computer evolution from the 1980s to the present, the internet and smartphone adoption, mm-hmm, and all the algorithmic trading and artificial intelligence we've just seen the beginning of that.
Yeah, and when you're talking about influencing behavior, I don't think anybody that has a smartphone gets influenced more on a daily basis than that these days.
Right.
So because it's in your face all the time, you're getting pings and dings and you have information, whether it's right or wrong, right at your fingertips, all the time.
Yeah. And so not just the technological evolution, but also personal experience. So all our beliefs are rooted in personal experience, and that can be family, community, societal. All those things can contribute.
Mm-hmm.
And experiences are some of the most difficult things for us to break. Our beliefs, right, and our habits are some of the hardest things to break. So we major investment challenges. So this is this is the core of what we're talking about today, the roots and reason behind decision making. Now, we're only going to cover 3 of these today, all right? So I'm going to go individually. There's anchoring bias, confirmation bias, recency bias, hurting bias, ambiguity, aversion, and myopic loss aversion. Okay, now that's for part 2, but today we're going to take on the first 3. So let's just look at that anchoring bias, and that's relying too heavily on information received first. So an example might be, hey, there's an expensive, well, not maybe expensive, but there's a certain priced item. And then you see up on the slide, hey, there's a pair of shoes that's $199.
Right.
Well, maybe nobody's, this is where anchoring comes in. Anchoring is most commonly used in facets of retail shopping, such as groceries, clothing, and car shopping. So you see a price, no one's buying the shoe that's $199, but everyone is dying to buy the one that is on discount.
For
$199.
It was originally $500.
Correct. So you could see that's the anchor. That's what that's the relying too heavily on information received first.
Right. So irregardless of what the true value is, you're making your decision based on what you perceive the price should be, or somebody tells you what the price is.
Exactly. So. Now, next is confirmation bias, and that's seeking out information that confirms an existing belief. So you're wanting to, so confirmation is the natural tendency for us to filter out information to retain only what confirms my belief. Now,
right.
I think my wife is very good at this. That she probably don't listen to this podcast, but
you're going to get in trouble here.
I know, but working against good behavior every day. I don't always do what I'm talking about, but I know I'm right.
Right. Yeah, and we all deal with that on a daily basis too. It feels good to be right. You want to be right. It takes a kind of a different mindset to open up to hear other viewpoints and then filter through those to find what actually is right. So that's a tough one for a lot of folks.
Yeah, they're truly just searching out the answers that they want to hear rather than the right answers.
Yeah, and we see that where we'll be explaining an investment to someone and they come in looking for a particular outcome, and if that outcome is in the explanation, they forget all the other parts and that kind of thing. They just hear what they're looking for, So we run into that, and you have to be careful to make sure that you're seeing both sides of every investment and the possible outcomes of said investment.
Correct. The third one we're going to talk about today, I told you we're going to go quick, but recency bias, and that's basing decisions only on the most recent information. All right, so it's when individuals make decisions based on recent results and on their perspective of those results.
Right.
And which may lend itself to making incorrect conclusions.
Right.
Based on the recent past. So.
Yeah, and I mean, right now in the current time we're in, I think that's really relevant with how things are changing on a daily basis politically, international scope. We're, just the news is hitting us with stuff coming out of Washington or out of the big companies. And so you got technology that's changing and something amazing happening every day. And you want to react to that, but you got to realize that sometimes that information's, you're still getting it late, to react.
Yeah. So Warren Buffett says, what we learn from history is that people don't learn from history.
Right.
And when investors get either fearful or too greedy, they sometimes hide behind that notion that this time it's different. And usually they end up regretting it.
Right.
So that's that's something really that we see quite a bit. And I used to hear, back in coming out of COVID, things just were going up, coming back. It just don't feel right.
Yeah.
Things just don't feel right.
Right.
But if you look historically, I mean, it's like the market's not always the same, but it does leave a trail of things that's gone over in history that's
cyclical.
Cyclical. Right. That's exactly right. So, let's dive into a couple other things. When we're talking about portfolios, a short-term focus can lead potentially to investing too conservatively. So I can just go over a quick example. So if you're looking at and evaluating a portfolio too frequently, it can lead to risk-averse behavior. So Fidelity, where we're gaining a lot of this information, and we can see it on the screen if you're watching us. So if you're constantly getting hit with reminders of volatility as an investor, it may cause investors to seek more conservative investments, regardless of the objectives or time horizon. So going against their objectives, going against their time horizon. A portfolio reviewed on a yearly basis that's a 70% stock and 30% bond portfolio. If the portfolio, they did some testing, Fidelity did, and they said if people reviewed on a monthly basis, meaning more often, they're taking looks at it. And the reason they're probably taking looks at it is because more often looks at it is because they're fearful, or maybe they're looking for, maybe they're being greedy or something like what we just talked about. And what Fidelity found out is because those things are constantly hitting people's minds, then the average person that looks at it, their portfolio on a monthly basis, they become more conservative.
Right.
59% bonds and 41% stocks. Now, so what does that mean for somebody? Then that basically, means that they're going against their time horizons and may not reach their full potential and not be able to grow their money. They're taking, 30%, almost 30% less upside potential in stocks.
Right. And, we have more access to that, have for the last decade or so, but even more so now, where you've got it on your phone, or it used to be that you could only review your account when your statement came in, and once a month or quarterly or probably annually back in the day. But now you can look at it minute by minute, and it makes you question, whether every time you look at it, it's human nature to say, "Am I doing the right thing here? Am I doing?"
That's a good point. That's a good point, and I got something for us on that too. But if you look back at during the past 22 years, the equity markets had more days of a greater than 2% decline than the prior 50-year period. And this chart up here shows there's 238 days. If you look back, this is a little bit older data from 2002 to 2023. There was quite a few more days that had that significant volatility than there was in the previous 50-year period. Right. So that's something to look at. But you were talking about information overload, and the amount of information at our fingertips is rising exponentially. The average American spends 5 hours and 24 minutes per day on their mobile device. Every Sunday morning, I get my screen time update, and I don't ever think it's correct. I
turn that off.
Yeah, it's depressing sometimes. But Americans check their phones on average 96 times per day, or once every 10 minutes. I think that's low. Especially if I'm bored,
I know sometimes I feel like mine's buzzing in my pocket even when it's not even buzzing.
Exactly.
I think that's an actual
problem
people have.
That's information overload's a real thing, and I just but how let's while we wrap up, let's just go through a couple things on how we might be able to address some of these biases or these behavioral challenges, if you will. The anchoring bias, acknowledge that the anchor when making decisions. Acknowledge what's going on, and then understand, address, and remember the goal, not the dollars.
Right.
And recognize that the ways choices are presented will affect the decision. So from our standpoint, we need to make sure that, finding out where that person's coming from and making sure we answer the questions or explain things in a way that, by no means is misleading, but it's to the facts.
Right.
And making sure we're getting all the questions or they have answered.
Absolutely. Yeah.
And, at the same time, from a confirmation bias perspective, admitting that different situations call for different expertise and seeking out confirmation of options is a surefire way to kind of group think. And I think we've done that at times, and I'd encourage you to make sure that you don't, we've never said we've got the answer for everything, but we can certainly find the answers in time and working with the right resources.
Right.
And I think that's helpful in these situations.
Yeah, and I think that's where, a good advisor or consultant can help you with that issue, that someone that'll listen to what your goals are, and then also what your concerns and what you're trying to achieve, how they all work together, and give you a third party viewpoint
Right.
of that. So
Right. And then the third that we're talking about today, the recency bias, is something that I think really comes down to communication. Individuals, we don't like to look at investments from a short-term perspective.
Mm-hmm.
Obviously, you need to do so when there's a lot of extravagant issues that's going on in the markets, but that's what we're there for. You gotta realize yesterday's truth is not tomorrow's, and no pattern continues forever. And in the explanation, and a pattern may be a short-term pattern is what we're talking about there,
right,
in the near term. So, the thing is if you're thinking about this from an individual investor standpoint, as you as a person, and we try to dive into it, getting to know our clients as well. But, as an individual investor, get to know yourself and be aware of what your tendencies are and how they can influence your decisions and certainly your financial decisions. And if you do that, then that can also help you to avoid panic selling.
Right.
It allows you to stay invested during times when the market's volatile and there's some uncertainty. It allows you to stay focused when you don't dwell on the past and you're more focused on your long-term goals and your time horizon. And then, the other thing is if you're out there doing it by yourself or have these questions, you need to consult with your financial advisor. If you're currently working with us, and there's stuff that you feel you don't clear on, that's what we're here for, is to answer those questions. But if you're doing it by yourself, that's where you can find some value potentially in having somebody coach you through these things.
Right. Yeah, and to kind of another point is when you know what the and I've touched on this earlier, but with the investments that you're in, when you know how they could potentially behave, you're prepared when they do behave that way, and you don't have to make that knee-jerk decision. So, all that kind of plays into that,
Right.
To avoid the knee-jerk selling or, thinking that you're going to head down a path long-term that may be a short-term path and that kind of thing.
And I think that's where we can come into play a whole lot more than maybe just going online.
Right.
As you get to these critical areas of pre-retirees, retirees, retirement income planning,
Right.
Philanthropic giving, tax situations,
Right.
you need to really, that's where we can be of assistance. And that's where we can tailor an investment plan, much like what you're saying, getting to know yourself, knowing what your goals are for your what you can do with your money in a realistic manner, and then get someone that could help you guide you through those emotional financial decisions. So, and getting that plan together that will address all those items, your investment plan, maximizing your retirement income potential and minimizing your tax exposure, and then guiding you through emotional financial decisions. That's nearly 7 in 10 investors working with an advisor have a formal plan.
Right.
And we try to work through individuals with that. So it's a lot to take in. We're going to cover the other 3 later on. But this is a lot of psychology and everything that goes on, but it is really, truly what having this knowledge allows individuals to make better decisions. Right.
And like I said earlier, we're all human. We all go through these emotions, no matter whether you're an investor or an advisor or, someone just starting to save and earn money. You're going to go through these stages, and knowing what they are helps you learn how to cope with them. So I hope this, is some good information for folks, and they're able to take this and use it to their benefit.
I hope so. I think this pertains to the young person and the older person too. I mean, it's not just for anyone. So we're glad you joined us today, and we look forward to you listen to us in the future. We're going to have part 2 coming out on this shortly as well, with the 3 other biases and some conversation about it. But, to follow us, you can go through our YouTube channel. You can go on Google Podcasts, Spotify. The Southeast Retirement Planners podcast is there. Mm-hmm. And certainly if you don't currently work with someone and would like to sit down for a complimentary financial checkup, you can call our office or find us online at scretirementplanners.com or call our office at 828-855-2067. And that information will be here if you're watching on the screen as well. So we thank you for joining us today, and we look forward to you listen to us in the future. Thank you.
Yep. Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.